Well, good morning. Welcome to the monthly webcast presented by the Pro Bono Partnership of Atlanta. My name is Sean Christie, and I'm here with Tim Carlton. We're both lawyers in Brian Kay's Sourcing and Strategic Services and FinTech Practice Group. We're here today to talk about best practices in accepting payment card payments. Before we get into the details of the presentation, I thought I'd start with a few things about the Pro Bono Partnership of Atlanta. And first, just to go over the mission of Pro Bono Partnership of Atlanta. The mission is to maximize the impact of pro bono engagement by connecting a network of attorneys with nonprofits in need of free business legal services. In order to be a client of Pro Bono Partnership, you must be a 501c3 nonprofit. You must be located in or serve the greater Atlanta area. You must serve low-income or disadvantaged individuals, and you must be unable to afford legal services. You can visit Pro Bono Partnership on the web at www.pbpatl.org. And then finally, one last piece of just administrivia before we get started. I do want to make clear that this webinar presents general guidelines for Georgia nonprofit organizations. It should not be construed as legal advice. You should always consult an attorney to address your particular situation. And with that, we'll get started with best practices in accepting payment card payments. And I'll start with the agenda, if you don't mind moving to the agenda slide. So today we're going to go over a few things. We're going to walk you through payment card background and terminology just to kind of make sure that we all are working from a common vernacular when we talk about payment card payments and risks and liabilities. We're going to talk about some risks and liabilities associated with accepting payment cards that you as merchants and nonprofit organizations take on just by virtue of accepting payment card payments. We'll spend a little bit of time on compliance requirements applicable to payment card payment transactions, particularly the PCI data security standards. We'll talk about the difference between accepting payments directly and accepting payments through a third-party processor, and what the benefits and the pros and cons of each might be. And then we'll spend the last bit of time talking about ways in which you as a nonprofit may be able to limit your exposure to risks and liabilities as a merchant accepting payment card payments. We will leave a little bit of time for questions at the end, so we'll be holding questions as they come in, and we'll address as many of them as we can at the end of the presentation. With that, I'm going to turn it over to my colleague Tim Carlton to get us started.
All right, thank you, Sean. As Sean mentioned, before getting started into some of the details on risks and liabilities of payment cards, we wanted to discuss some of the background terminology used in the payment card industry. So on the next slide, we've got a slide showing the different players in the payment ecosystem and the terminology used by the payment cards. So it all starts with the card holder, which is pretty straightforward. That is the person that has the payment card, and then the merchant, which would be the retailer or entity that's going to be accepting payment cards as a form of payment or possibly donations. And then behind the merchant is the acquiring bank, and that is the financial institution that enables the merchant to process and accept payment cards as a form of payment. And then on the other side, on the cardholder side, is the issuing bank. That is the bank that provides the payment card to the cardholder and takes payments from the cardholder. And then we've also identified payment facilitators. Those are various third-party service providers that perform services on behalf of the acquiring bank to the merchants and provide different type of payment processing services. For example, they provide card readers and other software that enables a merchant to read the payment cards and then encrypt the card data and then send that data and transmit that data securely to the acquiring bank. Payment networks are the different networks provided by the payment brands like American Express, Visa, MasterCard. And the point of sale device, that is the type terminology we've used to identify the devices that will be reading the cards. So on the next slide, We've kind of got an overview here of the point of sale process, how this typically works from a high level view. Uh, so this would be a diagram of what's called a card present transaction. So this is where a cardholder comes into a merchant's location and actually presents their card to the merchant. The merchant swipes the card at the point of sale device. Uh, the merchant then sends the data to the acquiring bank, who in turn forwards that data to the payment network, who will then route the data to the issuing bank. The issuing bank is the entity that's going to verify that the cardholder is authorized to use the card and has the appropriate funds or credit to make the purchase. Then the issuing bank will send an authorization code back in the reverse order through the network back to the merchant bank, or acquiring bank, sorry, and then to the merchant who concludes the sale with the cardholder. We've noted here that in reality, there are oftentimes what you may use a payment facilitator as the merchant. You may use a payment facilitator to kind of indirectly accept payments and provide the payment information to the merchant or acquiring bank. A pretty common example you see nowadays is Square. That's a payment processing service that's provided to a number of retailers that enables the retailer to read card data on iOS devices like an iPad and then send the information to the acquiring bank and through the payment network. Another common scenario is the card not present transaction. In this scenario we've kind of highlighted here is in the e-commerce scenario. So in this scenario, a merchant has a website that has a page where the cardholder can shop or make donations, depending on what's being provided, and pay or make a donation with their payment card. We've kind of highlighted here the typical way this works from what we see, which is a merchant using a third-party payment processor to provide a payment portal on their website so that the cardholder enters their data into the third-party gateway page and provides their information and payment card information. And in turn, that third party transmits the data to the acquiring bank, which goes through the same authorization process outlined on the previous slide. We'll talk later about how this indirect process may somewhat limit your liability associated with payment cards, because in the process outlined here, the merchant would never actually be seeing the payment card information from the cardholder, and you would be relying on the third-party gateway provider to secure that information and send it along. So now we'll turn to, now that we've gone through some of the background and terminology, we'll turn to the common risks and liabilities associated with accepting payment cards. There's really two buckets of liability. One being the liability associated with the fraudulently card holder using a credit card fraudulently. The other being the liability associated with data loss. This would be when an unauthorized third party gains access to the cardholder information that you may have in your possession as a result of accepting payment cards. So on the next slide, we've kind of outlined the fraud liability risk. So when a credit card or a payment card is used fraudulently, the risks associated with bearing that loss is allocated to the merchants, the cardholders, and the issuing banks, depending on the facts of how the fraud occurred. And in some instances, merchants would bear the loss of that fraudulent use through a process called a chargeback. When a cardholder disputes a charge due to fraud, the issuing bank will undergo a chargeback process and investigate the fraudulent use, and the issuing bank will then enter into a process with the merchant where the merchant has the obligation to demonstrate that the transaction was legitimate. And if the issuing bank determines that transaction was not legitimate, they may be entitled to take the value of the transaction through the chargeback process and then impose a chargeback fee on top of that. So if you are a merchant selling goods, for example, and you had to add a chargeback, you would not get paid for the goods, and you would also lose the value of the goods that were provided to the cardholder. And then on top of that, have to pay the chargeback fee imposed by the issuing bank. And just a couple of notes there. The risk of chargebacks in a card present transaction are pretty low. The card not present transactions, which we outlined in the e-commerce scenario, have a much higher chargeback rate. But recent change in the payment cards liability framework associated with the EMV chips may increase the risk associated with chargebacks in card present transactions. And so discuss the EMV chip really quickly, since I think we are probably all familiar with the EMV chips at this point. I think we all received a new credit card last year with the microprocessor chip in the upper left-hand corner. And the purpose of the EMV chip is to provide an additional layer of security in card present transactions. The EMV chip provides or addresses one particular type of risk associated with fraudulent use of credit cards, and that is the risk that the card is a legitimate card. What EMV does not do, EMV does not authenticate the user or provide any type of security that the user is authorized to use the card. So I could use someone else's card with the EMV chip and swipe it. The EMV chip is not going to prevent that type of use. What it will prevent is someone skimming cards and then creating fake credit cards with the cardholder data on them. One other point, the EMV chip does not address or provide any additional security in the card not present scenario. So the e-commerce situation, there's no further security afforded by the EMV chip cards. On the next slide, we've kind of highlighted why EMV may matter to you as a merchant accepting credit cards. On October 1, 2015, the payment cards shifted their default liability framework for bearing the risk of chargebacks for card present transactions. Under the new liability framework, between the cardholder and the merchant, whoever has the least secure technology bears the risk associated with the fraudulent use of the card. So really the only scenario that comes up in is if a cardholder presents an EMV chipped card, but the merchant uses the mag stripe reader to process the card. If there is later a fraudulent use claim, the merchant would bear the liability associated with that use. And with that, we'll now turn to the other bucket of potential risk, which is the data loss liability.
Slide 11. Okay, great. Thank you, Tim. So as Tim mentioned, there are two types of liability that you face as merchants. We've been through fraud liability. Data loss liability is probably the one you hear more about in the news, and we hear about all these data breaches today. I think we've almost become somewhat cold to them or accustomed to them. But there is a lot of liability associated with data breaches. We've put some numbers up on the slide just to give you an idea of what the cost exposure is. These are numbers from a study that's commissioned by IBM each year through an institute called the Ponemon Institute. And it sets out what your average cost per record is if you do suffer a data breach. And that average cost is about $221. If you peg the average cost of a data breach in total The average data breach cost is $6 million. For most of you as merchants, I think your exposure is going to be a lot lower because you would probably process fewer transactions, but it's still relative. So $221 per record is still a big number for you and your organizations. So we'll talk a little bit now, moving into the next section of the presentation about what compliance requirements apply to payment card payments. If we could go on to slide 13, I just wanted to give you some idea of the framework of how the compliance obligations are created and flowed down to you as a merchant. So if you look at the primary issuing banks, if you will, or primary payment card entities in the marketplace, American Express, Visa, MasterCard, Discover, these entities all comprise the PCI Standards Council. They create and promulgate the data security standards that apply to payment card transactions as well as to payment card applications. Those things together with their kind of brand security requirements are flowed down via contract to what Tim referred to as the acquiring bank or the merchant bank, or in some cases the payment facilitator or payment processor. So when you as a merchant sign up with a Square or a First Data or a Bank of America Merchant Services, or if you were to do kind of a direct payment model where you contracted directly with an acquiring bank, all of these obligations that are promulgated by the PCI folks will be flowed down to you through those contracts. So I wanted to set that as kind of a framework of where the data security standards come from. If we move to the next slide, we've kind of listed out the PCI data security standards. And they are really tied to, there are 12 standards. They're tied to a number of goals. I won't read through them all because I'm not sure that's a useful exercise in this context, but I did want you to have them for reference. There are a few things, though, that I would like to highlight for you because I think they're relevant to merchants generally, as well as nonprofit merchants that might be accepting donations or perhaps accepting payment for fundraiser type activities. One thing you always need to remember is, if at all possible, you should try not to keep and store cardholder data. And we'll talk about how you can avoid having to keep and store it. If you do need to keep and store cardholder data, for instance, if you take payment card information over the phone, you need to secure that data and limit access to only those folks that need to have access to it. And you need to have some policies in place that provide for maintenance, storage, and security of information that you do retain. So we'll cover over all that in a little more detail in the following slides, but just wanted to give you at a high level a view of what the PCI data security standards are. If we go to the next slide, in addition to the PCI data security standards, you also are subject to brand and network security requirements that are flowed down by the different payment card brands. Those requirements require compliance validation in some cases, and the level of scrutiny that's applied to you as a merchant really depends on the model with which you enter the marketplace, whether you go through a payment facilitator, whether you use indirect payment in the e-commerce model that Tim talked about, or whether you are directly accepting payments. We believe that most of the folks in the audience on this webinar today will be going through a payment facilitator, and we'll be going through some sort of intermediary from an e-commerce perspective. It's unlikely in our minds to think that that nonprofit organizations, or most organizations for that matter, would take direct payment and would take responsibility for processing payment card payments. So with that in mind, and with that kind of engagement model in mind, your compliance obligations in large part are shifted to your vendor. If you hire Square, for example, as your payment facilitator, they take on a lot of these PCI data security standards compliance obligations, and they take on a lot of the compliance obligations with the brand and network security requirements. However, there will still be some obligations that flow down to you pursuant to your contract with the payment facilitator. For instance, you're probably going to have to complete some sort of attestation, which we get into on the next slide if you'll advance to slide 16. So the data security standards and the brand and network security standards do require merchants, either directly or through their payment facilitators, to provide some self-assessment and some reassurance that the data security standards are being met on a periodic basis. As I mentioned before, these requirements more likely than not for you all will be less onerous if you go through a payment facilitator or through an intermediary in the e-commerce situation. But I expect that you will have to do some sort of self-attestation, and that's something that your payment facilitator should be able to help you with. It's going to be an obligation you take on in your contract, but from what we've seen in the marketplace, the facilitators are good about helping their merchants work through the attestation process and providing the documentation that's required to validate and confirm compliance. If you were to enter into a direct payment model, which again I think is unlikely, you probably would be obligated to perform network scans by an approved scanning vendor. If that's a model you want to pursue, you probably need to think through that with legal counsel and understand what the requirements are from the PCI data security standards perspective, as well as from the brand and network security standards perspective. But the network scanning vendors that you're allowed to use through PCI are on the PCI website, which is linked in the presentation. So if we go through if we go to the next slide, just go through a few kind of key requirements. You should avoid storing payment card data electronically if at all possible. If you're accepting payments through a payment facilitator or through an intermediary, you shouldn't be storing payment card payments or payment card numbers electronically. If you're going to store the primary account number, which is the credit card number, it should be obfuscated such that, either electronically using some sort of obfuscation software, or if it's in a paper record, you cover over some of the numbers or mark out some of the numbers so that if someone were to get access to the information, they wouldn't have the full account number. Certain types of payment card data should never be stored. The CVV number on the back of the card, for example, or on the Amex cards, the 4-digit number on the front. There is no reason to store that information, and you should not store it after the transaction has been consummated. And then if you are going to contract with a third party to store or process payment card data, you must flow down the obligation for the third party to comply with the PCI data security standards. That should be a part of your payment facilitator contracts or your intermediary contracts, and that's something that your legal counsel can review and help you work through. So if we move on to slide 18 and then 19, talk a little bit about direct payment versus third-party processors and really our recommendations to you on how you limit your liability, and then we'll open up for questions. So on slide 19, if you look at direct payment, the most obvious advantage is that you have more information and systems control. You control how the payments are processed. You control how the information is stored. However, I will say for institutions of limited means that are trying to manage to tight budgets, you're not likely maintaining the information technology staff and the data security staff to be able to do this effectively. In a direct payment model, the PCI data security standards compliance obligations are largely shifted to you as a merchant, whereas in the indirect payment model, they would be taken on by your payment facilitator. And as a direct payment, processor, you're taking on a lot more risk and liability for both fraud and data breach and data loss. And that's why we say, we see most entities shifting to the right side of the slide and going through an indirect payment model, going through a Bank of America Merchant Services or a Square or some sort of payment facilitator, shifting the burden of PCI compliance, shifting the burden of maintaining all the infrastructure and the data security, keeping data security current, shifting the burden of the network scanning and PCI compliance validation to that third party. It's more of a fully outsourced model. The only downside is it does carry a higher per transaction fee, and maybe there's a little bit less of convenience and a little bit less flexibility in terms of how you might brand the payment card interface, if you will. But I think on balance for most of you all, the indirect payment model is probably the more desirable model for a lot of reasons. So a few points on limiting your liability. Regardless of how you take payments, whether it's direct or indirect, whether you use a facilitator or not, you really need to maintain a compliance policy. That's going to be required to be a part of any self-attestation you have to provide, whether it's because you're directly accepting payments or going through a payment facilitator. As we've mentioned before, try not to store payment card data if it can be avoided. limit access to data that you do store and retain on a need-to-know basis. Make sure the information, if it's physical, it's secured physically. If it's electronic, that it's secured electronically. And then if we move on to slide 21, you will need to regularly validate your compliance as required by your facilitator contracts. If at all possible, try to go the indirect model, use the fully outsourced model. And then one point I did want to mention on terminal solutions. To the extent that you're able to afford it, we would encourage you to use lower risk terminal solutions. So your payment facilitators will offer you as an option tokenization and tokenized payment card readers that actually send tokens over the network instead of card numbers over the network. If you're able to accept Apple Pay or Samsung Pay or Google Pay, those are more secure methods of accepting payment card payments. They're great ways to limit your liability. In some cases they may be a little more expensive, but I think that the risk shifting and risk attenuation that occurs is perhaps worth that additional expense. And then the last point I would make is, you should engage legal counsel immediately if you do suffer a data loss. It's important for a lot of reasons, not only to think through what you need to do to comply with your network contracts, your payment facilitator contracts, state law, federal law, etc., but also because your outside counsel can help you protect and shield, whatever information needs to be protected under attorney-client privilege. So if you encounter fraud or data loss, I think one of the first calls you make is to your legal counsel. So with that, I think it's good to open it up for questions. I'll ask Robin what questions we've had come in. I think most folks. Oh, I'm sorry. So the question that was asked by Robin is, where do most merchants obtain a data security policy? And what I would say is there's not, you probably have a hard time going out on the web and just finding one. I think the best place to start is if you have legal counsel. They probably have policies they've drafted for other clients. Certainly your payment facilitators or whoever you're contracting with should be able to help you with that as well. And I'm sure they have policies that, best practices, if you will, that they can give you from, their materials and from other clients. It's something that, your lawyers should be able to do, failing that, though. No other questions? All right. Well, listen, we appreciate everyone's time. If you need any more information about this topic or Pro Bono Partnership of Atlanta, we have on the last slide contact information for the Pro Bono Partnership. We do appreciate you all taking the time to join in and participate today and to listen to us speak about this subject. Thank you very much.